Howdy, Jacob here. Today we're looking at Broadcom. All right, so it is in the semiconductor and semiconductor equipment industry. It was founded in 1961 in Palo Alto, California. $600 billion market cap, essentially the same enterprise value. Wow, ginormous growth here. Just absolutely bonkers. Over the last 10 years, their lowest year-over-year revenue growth was 5.7%, and margins are up so much so that in 2014, their gross margin was 44%, and now their operating margin is 46%. That's a feat. That's a feat if I ever heard that. So dividend up 17 times, essentially. Earnings per share up 33 times. Return on invested capital, honestly, lower than what I thought. Interesting. So the last 5 years, 5%, 5%, 10%, 18%, 22%. A little bit surprising there. So let's look at the balance sheet. I didn't see a lot of debt. So 14 billion cash on hand. 39 billion in total debt. But in relation to cash flow, 38 is nothing for them. Their use of cash flow appears to be a little bit of acquisitions, maybe a little bit of debt repayment, and then pretty much split between stock repurchases and paying for a dividend. So their dividend of 7.6 billion aggregate. And I mean, yeah, their cash flow has grown so much, but let's say 5-year average, let's lean towards the heavier end and say it's 15 billion. I mean, you're still looking at a 50% payout ratio for a company that should still be growing like crazy, should hopefully be reinvesting in themselves at high rates of return. I feel like this company, I'm just very surprised at how low this return on invested capital is. Obviously, this 22%, 18%, 28% is fantastic, but the fact that their down years were mid-single digits, I feel like on some of those other semiconductor stocks, we were not seeing that. So maybe it does make sense that they're paying out a dividend. Maybe their reinvestment opportunity isn't great, but then they're growing so substantially that I just find that interesting. But let's start making some assumptions here. I'd say that I wouldn't be surprised if they grew at, let's say, 8% a year. Margins have gone up, let's say, and their free cash flow is higher. Absolutely adore that. Let's say 40. They're so far apart. I'm going to say 45, 50 share change, maybe 0%. So they were buying back a lot of shares, but their stock-based compensation is over 2 billion. Okay. So maybe let's say they buy back 5 billion. That's about 1%, and then net out the stock-based compensation. So let's do maybe just 0.75% decrease in shares a year. Terminal PE, 8% growth, huge market cap, likely moat, as you can see from the margins. I'll probably throw a 20p in price to free cash flow at the end of 7 years. And then the dividend, they can afford the dividend. I'll probably put it with growth of the revenue. And it's going to have to fall 53% to get us the return we're looking for, given these assumptions. Yeah, I could see it increase the revenue change if you really think that their ability to grow is higher than this, but I always lean on the more conservative end, and my other assumptions I feel like are, on the frothier end, honestly. So even falling 50% would be, interesting to do a deeper dive on to see if these margins are attainable or whether it's maybe at the top of its cyclicality. But it just looks like a great business, something I definitely want to own. I just want to own it at the right price again. So hopefully everyone enjoyed the video and has a great rest of the day. Thank you.